Ben, I spoke mostly about the stock market there. We talked a little bit about the state of play with regard to rates. On balance, is this a market that is due for some kind of a churn and perhaps consolidation at lower levels?
Good morning, Dom. I think it is because, the tone within the FOMC is really changing after that payroll report. I found it notable when Raphael Bostic was interviewed on CNBC, and just yesterday, Mary Daly too. Both of them have shifted quickly to what we call risk management within the FOMC, meaning paying really attention to what's happening now in the weakening of the labor market. So it's very possible, Don, that this rate cut that's likely, I think, in September could be larger than 25 basis points. And that maybe put a little bit more downward pressure on treasury yields, maybe sub 4%, because that's not really priced in at this moment, 50 basis points. But it does look likely, in terms, from my view, that it repeats itself from what we had last year, with that similar sort of weakening of conditions in labor just around the time that the economy sort of was meandering through the summer. So it feels similar. I think therefore it sets up for a September potentially larger rate cut.
Ben, what happened to the whole bond yields going down, good for markets, boosting bond prices, even boosting equity markets? Is this a different regime now where the economic data showing hypothetically or potentially a possible slowdown is one that's indicative that will translate into a downward market move? Or are we in a situation where rate cuts and the prospect for more could boost overall markets for assets overall?
I think it's the latter, Dom. I think it's still a situation where if the Fed now jumps ahead of this issue with what we're seeing in developing the jobs market, then the market will take it like an insurance rate cut. And that means that you're getting basically, putting a stop to the weakening overall on labor in the future. And that would actually be the good news. But you're right about that. If it goes too slow, and it's, in the language of the too late idea, but if it goes too slow with rate cuts, then the economy keeps deteriorating, it would be the bad news. I'm more of the good news camp. I think that if the Fed really delivers a few rate cuts, actually the market will get enough fuel to rally on into year end. So I think it's more of that direction rather than the negative news.
So as you price out your assumptions and you look at the factors going into all of your various models, what exactly do you see for markets as we head towards the end of this year? Is it something where it can be near-term volatility to the downside and then constructive for the balance of the year? Or do you feel as though there's not enough information yet to find a forecast for both bond prices and equity prices?
Well, there's some information. We can conclude that there's slowdown that we saw from the GDP data, and we can conclude that it has spilled over to the jobs market. So that's your assumption that the market itself has to adjust to that reality. That's what happened last Friday, and we may see more of this into this month, into the early September, when more of the data comes out. But then I do think that if there's enough, as we know, stimulus from fiscal comes in next year and the Fed steps ahead of this issue, I can assume that we end up the year actually quite well on the stock market. We probably will reach anywhere from 6,500 to 6,700 on the upside on the S&P from my perspective, simply because it's not an economy that will slip off into a recession. It's more of a slowdown. If you arrest the slowdown, you'll be in good shape.
Hey, Ben, your firm's name is FedWatch Advisors. So if you're watching the Fed, how important is the new incoming governor nominee to replace Adriana Kugler?
It's definitely important because this is a new position, and Adriana Kugler was a more academic person who I think was more centric in terms of the views. She didn't really take an outspoken view on rates. So this new person may do that. Whoever that will be. There's a lot of speculation about who it will be. I don't know that actually, but I can see this person being more focused on we have to be more proactive with interest rates to steer the economy, which means initially you have to bring rates more down to prop up the economy, so to speak, to lift it through this slowdown from the tariffs. I think the change ahead of it. And I believe, though, that the market's already pricing this. You can tell from the futures from, let's say, May until the end of next year, we're actually almost close to 3% on the funds rate. And that's something I think of a major change. So markets anticipating this will be a person with a more vocal chord in terms of interest rates saying we have to cut rates faster.